In today's video, we are going to talk about the question that a lot of people have. How much of my money should I invest? This is an important question because if we are investing too little or too much, it can have significant consequences on our financial goals. Knowing how much of my money should I invest is very important because we want to make sure that we have enough money on hand for emergencies, but we also want to be investing our money so that we can retire sooner than later. We are going to discuss your financial goals and your risk tolerance and a popular rule of thumb to use. And also we will determine your investing strategy. We'll talk about diversification and also reevaluating where we are and adjusting if necessary, and the help that you can receive if you want. All right, so the first thing we want to talk about is your financial goals, because this is going to make a big difference on the amount that you want to be investing. Before we can determine how much of your money to invest, we want to determine what are your financial goals. Ask yourself, what is it that you want to achieve in the short term and in the long term? Are you saving for a down payment on a home, or are you saving for retirement? Or are you saving up for an emergency fund or a trip to Hawaii? Or maybe you want to start your own business and you're going to need some capital for that. Having a clear understanding of all of your different financial goals, short-term and long-term, is going to help you determine how much of your money to invest. For example, I knew that one of my financial goals was to purchase my fourth property. So I knew I needed to save up for a down payment for that property. I also knew that I wanted to achieve financial freedom, that I wanted to retire early, but I knew that I wanted to purchase that property in order to help me do that. So I couldn't be investing all of my extra money in the stock market. And by putting money aside, I was able to purchase that fourth property. But not only that, I took money from my brokerage account, money that I had invested in the stock market, to put toward that down payment. So when you are determining your financial goals, it doesn't mean that you need to leave all of your money in a savings account to reach a certain financial goal. You could still be investing a certain percentage. And if you are investing in a brokerage account, for example, you could even take that money out and put it toward something else that you were saving up for. So we do have some flexibility here, but we really need to be clear on what our goals are. And I was actually talking to a client just yesterday, and he wants to buy a property, but he also is nervous about not having enough money in case something goes wrong with the property. So he was investing a significant amount in his 401k through his employer, but he decided to pull a little bit of that money out and put it in a savings account so he could have enough for a down payment by the end of the year, and also have a little bit extra in case there was some type of emergency. He doesn't want to just be house poor. But it was fun talking with him and helping him decide how much to invest in the stock market and how much to put to the side for real estate. Comment below and tell me what one of your financial goals is. And when we are creating these financial goals, we want to be really specific with them and have a time frame associated with them. We don't want to just say, I want to pay off $5,000 worth of debt, right? We want to say, okay, I want to pay off $5,000 worth of debt in 12 months. We want to be really specific so we know exactly what we are working towards. And that way it makes it a lot easier to determine how much we should be investing. If we aren't setting any financial goals at all, then we would just be spending our money whenever and wherever, and if there's some left over, then we would be investing it. And we don't want to take that approach. We want to think, okay, what is it I want to achieve in the short term within maybe 6 months or 12 months? And what do I want to achieve within 10 years, 15 years? Where do I want to be? And then work backward. Okay, how can I get there? If I want to have a $12,000 emergency fund saved up in 12 months, how much do I need to contribute every single month to get there? Or if I want to retire by age 50, how much do I need to be investing every single month in order to get me there? And if you are wondering how much you're going to need to retire, I do have another video for you. I will leave a link above. You can check that out later on. All right, once we have our specific financial goals, the second part is to understand our risk tolerance. Risk tolerance is the willingness to take on some type of risk in order to possibly receive greater returns. It's important that you take into different factors when you are deciding your risk tolerance. For example, how much time do you have to invest? If we're going to be making really risky investments and we only have 2 years to invest, that is probably not the wisest move. But if we have 20 years to invest, then we definitely want to be riskier so that we can get those potentially higher returns. And if we think, well, we know we want to get higher returns, but we're also really nervous and we know that we are going to pull our money out if it all of a sudden starts to dip down, then that is not going to work for us. So determine how much risk you are willing to tolerate in order to get those higher returns. And for me personally, I feel like I have a pretty high risk tolerance. I invest only in stocks in the stock market. I'm not in any bonds. And I'm completely fine with that. I know that the stock market has gone down recently, but I'm not worried. I'm not pulling my money out and locking in my losses. I'm leaving it in there. I even put more money in the stock market because I have that long-term mindset. I'm not worried about pulling out my money within the next 6 months. So I know I have a longer time horizon to invest, and I know that my investments will continue to go up over the long term. And my client that I was just talking with yesterday, he is very young actually, and I let him know that if I were him, I would be completely invested in stocks, no bonds, because he needs to be building up his wealth right now and not be worried about preserving it. He has a long time horizon in front of him. But to share another example, one of my friends at church a while ago had invested in the stock market, and I don't know exactly what type of fund or stocks that she was investing in, but it was when the entire market had gone down and she had gotten so nervous that she sold all of her investments and did not want to invest in the stock market again. She locked in all of her losses. She was investing at too high of a risk tolerance for herself. So do not make that mistake. Make sure you know your risk tolerance and invest accordingly. And the third thing that I want to share with you is a rule of thumb, and maybe you have heard of this before, but it's a popular way to figure out how much you should be investing. It's called the 50-30-20 rule, and it suggests that 50% of your income should be going toward your expenses, such as rent or a mortgage payment, utilities, your phone bill, if you have a car payment, things like that. And then 30% of your income should be going toward discretionary expenses. Things like entertainment, going to a play or a movie, or traveling, or buying a cute new outfit, different things like that. And then the remaining 20% should go toward savings and investments. So if you already have an emergency fund set up, and you are not saving for anything in particular, then the rest of that should be going toward investments. So you should be investing 20% of your income if you already have your savings set up. And if you don't have an emergency fund set up, then you want to put that full 20% toward an emergency fund. Once that is set up, then you can start investing your money. And I know a lot of people like this rule of thumb, but I feel like we are all in such unique situations that we need to take a look at our own financial goals and see if this will actually work for us. Because if we want to retire even earlier, we are going to want to invest more than 20% of our income. So while yes, this is a good baseline to get started, really determine your own financial goals and what is going to really help you achieve those goals. Comment below and tell me if you have heard of this 50-30-20 rule before. And the fourth item that I want to talk about is your investment strategy. Once you know what your financial goals are, you know your risk tolerance, it's important to come up with your own investment strategy. And this includes which type of investments that you want to be making, such as stocks or bonds or real estate, and then how much to allocate toward each of those investments. And to share my own investing strategy with you, I like investing in real estate and the stock market. And lately, I have switched more over to investing in the stock market. I feel good with having just 3 properties right now. They are pretty easy to manage, and I've paid off 2 of those properties already. So I just have a mortgage left on 1 property. And I feel like I may eventually pay that one off instead of purchasing another property. We will see how things go later on, but that's what I'm leaning toward right now. And yes, I know I can make more money if I invest more money in the stock market instead of paying down my mortgage. But here's the thing, it's my own investment plan, it's my own investment strategy. and I want to do what I want to do. Personal finance is not just about the numbers, it is very personal. So while yes, sometimes it makes more financial sense to do a certain thing or make a certain investment or pay off a certain debt first, that's not always the route that we should go because it doesn't always align with what we think or with what we feel. So make sure when you are setting up your investment plan that you feel good about your investing plan. So for right now, I am still investing money in the stock market every single month. I have that completely automated, but I'm also investing in my business, which I feel like will grow over time and generate more cash flow for me. So I'm also investing in that. And since I invest in real estate and the stock market, there is a balance there on how much I should be saving for a down payment or how much I should be investing in the stock market. And it's not an exact science, it's more of an art. So if I feel like, oh, I need to put some extra in the stock market, then I go ahead and do that. Or when I felt like I needed to pay off a property, then I went ahead and did that. So as you're making your plan, know that you can make adjustments along the way. All right, the fifth part I want to talk about is diversifying your portfolio. All this means is that you are not investing in one single investment, like having all of your eggs in one basket. You want to diversify. You don't have to do real estate and the stock market. You can just do different investments inside of the stock market, but you don't want to just buy one single company in the stock market and put all of your money into that company. That's very, very risky. So if you are just investing in the stock market, make sure you have different investments in the stock market. And keep in mind that risk tolerance. If you feel like you're going to sell all of your investments if they start to go down, then maybe you do want some in stocks and some in bonds. Diversify the way that it works for you. And then the sixth item I want to talk about is reevaluating and adjusting as you go along. I know I kind of mentioned this before, that things change over time. I'm not so interested in buying another property right now. So I am investing in the stock market. But in the beginning, I was definitely saving up for a down payment to purchase another property. So as you're going along, just reevaluate. Where are you with things right now? Are you still wanting the original financial goal that you set, or has that changed a little bit? And then make adjustments accordingly. These things are not set in stone. You can make changes and adjust according to your needs and your desires and even fluctuations in the market. For example, when the real estate market was super high, that did play a factor in me selling my property. It was not the only reason I sold, but it did play a part. We definitely want to be investing as much money as possible as soon as possible so that we can take advantage of compound interest or appreciation if we are investing in real estate. But we need to take a look at our own situation and make sure that we feel good about investing that amount. And if you want help investing in the stock market, I have a free masterclass for you. I will leave a link below in the description. You can click on that and watch the free masterclass and figure out how to best invest in the stock market for you. If you found this video helpful, please hit that like button and share it with someone else who would like to hear this information. And hit the subscribe button to subscribe to my YouTube channel and hit the little bell to get notified on when I post new videos. And if you want to see even more awesome content from me, make sure and check out the videos on the side of the screen. Thanks so much for watching. I'll see you in the next video.